Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 20th, 2022. Appreciate you all tuning in this week to this channel as well as our podcast InvestTalk and subscribing to both. Now this week I am titling the video, Retailers Feel the Sting of Inflation. And I'm going to get to the charts of some of the big retailers, Target, Walmart, etc. But I want to start off with some economic figures. The first is the initial unemployment claims. And now this has been in a long decline, especially as unemployment, as the labor market continues to remain very tight. And we were near record lows. Obviously, we had this big COVID spike. But if you just go back a year, this has just started to make now an uptrend, really since the beginning of April. So not even 2 months, but still there's a pretty clear uptrend here. Now, nowhere near worry. And I think that's what the market is freaking out a little bit, and it makes good headlines. Everyone's talking about it. Oh, we're going to recession, and that's certainly a possibility. You can't rule that out. And we're certainly trending that way, but so many people are assured that we're in a recession. Well, if you look at unemployment, unemployment's still very low. Although we're getting some uptick here, you're getting layoffs from the big tech guys, where there's trying to get to profitability, and the tech sector is refocusing on profitability, as I spoke about this week on the show. And that means layoffs for workers that weren't really needed. Pelotons of the world, Zooms of the world. These are companies that are cutting staff. Even Amazon, which came out with earnings, a week or two ago, and basically said that they're not going to be aggressively hiring more, for example. So, you're starting to see the job market weaken. And then you look at building permits, that's down 3% month over month. And you get these bouts here of declines. But you can see it's been more consistently negative, and even the pops above have been more modest. So building permits definitely in decline, existing home sales in decline, and the Wells Fargo U.S. housing market index, you see that certainly rolling over. Then you look at industrial production, that remains strong, and I think that is probably going to be the bright spot of our economy for a while, which is, hey, we're onshoring our manufacturing in a big way, and companies want more resilient supply chains versus just-in-time inventory. And that's something that will be a continuous trend. So I think our industrial sector will remain relatively robust, and thus probably prevent us from going to any major recession. Now, wholesale inventories month over month, those continue to go up, and I'm hearing anecdotally from business leaders that I know that are seeing big box retailers really cut their inventories, and they're not working through inventories nearly as fast as they were in the past. Now, I want to go to first the S&P. Certainly a down week, but look at this Friday. Look what happened today on Friday, where you had this big reversal candle on volume, closed in the top, kind of third of the candle. That's what we call a bottoming tail, and certainly pretends to probably some upside in the medium, short to medium term. Now today was OpEx, so there's a lot of game playing and whipsawing. But oftentimes, especially going into the end of the month, where you have a lot of rebalancing, and when stocks are down, these funds that tend to rebalance monthly, they will be buying more stocks because now their weighting towards equities are lower. And so you tend to get a lift into month end post OpEx, and I could see that happening. We have about a week and a half left before the end of the month. So if we get a pause day on Monday, something, at least a decent day in the market, nothing like a big sell off, I think we could see some near term follow through that would I think catch a lot of people off guard, because people are really positioned for a big breakdown lower, and I just don't see that in the short term. Now, what really weighed on the market today, or this week, excuse me, and that was Target and Walmart. The Target's earnings were on Wednesday. They were much worse than expected. Showed the increasing costs of shipping, labor, etc., that are weighing on profits overall. Same with Walmart. that came out with earnings the day before that and was also terrible. So we had kind of that fall through. And then there was contagion across the board. You had Costco really falling out of bed, along with Best Buy. I mean, I could go with a lot of retailers here, but you're just showing that these are names that didn't really have any news of themselves, but because Walmart and Target is so big, the market starts to price that in for other retailers, whether or not that's as much of a reality for them or not, but certainly hurt those names. And that spread, and that was kind of a fall through, honestly, with what happened with Amazon's earnings a few weeks ago, where they were talking, like I said at the top of this video, about the cost of doing business, delivery, labor, etc. And that certainly hurt their profits overall. And now you're getting some fall through in other parts of the tech space. Obviously, Tesla now down about 50% from its high, 45% or so, and closed at the lowest level since, let's go back to July of last year. And that momentum is clearly pointed down. Obviously, Elon with the sexual assault charges, as well as the whole Twitter fiasco, and whether or not they're going to force him to pay, and could that create a margin call, etc. You're seeing that come back down to earth. The market's really pricing in the Twitter thing is just simply not going to happen. And so, if you look at the broader consumer-facing industries, so discretionary, how weak that was, even going into this week because of Amazon, but even more weakness this week. And then you have XLP, which actually has a lot of those Walmarts and Targets of the world. That really fell out of bed as well. And then there was contagion into other parts of consumer staples. Now, where there was not contagion continues to be commodities. We're in a structural commodity deficit. So this is DBC. That continues to just grind higher. Even the basic materials, still making a series of higher highs and higher lows. So yes, some contagion in the near term over the past month or so, but overall, there's absolutely nothing wrong. Let's go to IYM. Let's just look at the S&P. You're going to say, yeah, there was a pullback in IYM, but the relative strength continues to be very, very strong. Other areas that are getting nice support, the utility sector, that once again got some contagion, but found a ton of support here right at the 100-day moving average, and looks to be moving higher, especially if the market gets a bounce. XLE, energy sector, just continue to grind higher, as well as healthcare. So XLV, that was actually up on the week. So healthcare is also getting some flows. And it just shows you flight to safety, flight to hard assets, flight to real things today. Companies that can produce electricity, deliver natural gas, deliver water, utility companies, about cash flows and dividends and profits today. Same with healthcare companies, some of the most stable, consistent companies out there. And those are continuing to get flows. It's not about the story stocks anymore. It's not about those revolutionary businesses, because those have already been priced ridiculously high levels, and now those are coming back in, and the markets, those funds have to go somewhere, either cash, which cash levels are near record highs, or they pivot to other parts of the market that are finding relative strength. And I think that's what you got to continue to do. Now, what's interesting to me about this week was that, look at ARK. ARK was just kind of consolidating. It was actually a bull flag from the move up late last week, and it tells me that there could be some near-term follow-through on ARK, and a lot of that has to do, I think, with interest rates. We talked about higher interest rates, bad for the tech space, bad for growth stocks. And I think you're going to continue to see that trend longer term. But near term, I think you're getting a little boost here from lower rates. If you look at the SHY, I've talked about this before, this starting to grind higher. Look at the MACD. It's powering up towards the zero line. And remember, when the MACD gets above the zero line, that's a positive trend. It's a positive signal. Still below. So you can't count your chickens before they hatch, but certainly a positive sign for interest rates coming back down and the Fed pivoting, maybe not to QE, to back to cutting rates or anything like that, but just moderating the pace of their rate hikes. And I think that's what the Fed is probably going to do. Now they're starting to see unemployment rates ticking up. They've kind of had this detonation in the overpriced sectors, of the market, asset classes around the world, including crypto. And they don't want it to become disorderly, and that becomes a more difficult thing to kind of clean up. So the bond market is telling me that the Fed is likely to pivot in the near term very subtly. Now, HYG to the IEF, so junk spreads, certainly widening out, but not to a level that's drastically concerning. Now, you always have to remember that the junk bonds, they tend to be skewed more towards energy. So obviously energy companies are doing well. So that continues to do well. What's interesting is the LQD, the investment grade. That's actually weaker, and that's showing more stress in the credit markets, where typically it shows up in high yield. But like I said, about 40% of high yield market is energy, and that's not. There's nothing wrong with companies that produce energy. Those are doing well and actually repairing balance sheets in this environment. So. Near term, I do feel like the VIX. You kind of had some extreme levels, extreme oversold nature of the market, and a lot of people, sentiment to me is getting very, very bearish. And the economic backdrop, while weakening, it's more of a reversion to the mean. I've talked about on the show on Thursday about how delinquencies for subprime auto loans and personal loans are increasing at a pretty fast clip 8 months in a row. But if you look at the actual total, it's just kind of close to where we were pre-COVID. And we weren't in a recession then, and that wasn't a great economic environment, but it was certainly not horrible. So what a lot of this is just, hey, stimulus has rolled off, not just monetary but fiscal, and the consumer is kind of tapped out when it comes to all the savings and pay down of debt that they did over the past couple of years. And so now we're getting to a more normal environment. Now the trend is certainly poor, but once again, the Fed is not going to want to cause a disorderly sell-off in risk assets in the economy, et cetera. And the bond market is starting to sniff out that they will moderate their tone, and that could easily give a relief rally to the markets. Now, is that a rally that will likely stick? I could argue no, pretty easily. But you don't want to get too offsides in the near term. So, just want to give you that sense of what I'm feeling in the market after Option X week and going into the end of the month. And I hope this was informative and insightful for you. I want to remind you the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own, do not represent those of KPP Financial and those associated. And yeah, so I appreciate you all tuning in, and have a wonderful weekend.